Our next guest is optimistic on small caps and sees 6 sectors advancing double digits. CFRA Research Chief Investment Strategist Sam Stovall has a year-end S&P target of 45.75, and he joins us now. So, Sam, why small caps, which they haven't participated? Is that why? Why are they poised to do so now?
Well, good morning, Sarah. Small cap stocks, have been underperformers. Traditionally, in the first year of a new bull market, they have outpaced large cap stocks by a 2-to-1 margin. This time around, however, while the S&P was up more than 21%, the Russell 2000 was higher by just about 3%. And I think that's because of the hawkish rhetoric as well as leanings by the Fed. But now that the Fed has likely ended its rate tightening program, and also we think that the Fed will be starting to cut rates in the third quarter of next year, that has allowed investors to start to nibble at these small caps once again.
But rates are still high, even if they peaked or starting to come down, Sam. And doesn't that disproportionately hurt the earnings power of some of these companies?
Well, we have been seeing earnings estimates come down a little bit for 2024. Expectations were for about a 12% gain in the S&P 500. Now it's about 10.7, according to S&P Capital IQ consensus estimates. But we're still looking at about an 18% rise for small cap stocks. So while there has been a commensurate decline in small cap estimates, certainly still leading the large caps. And also we're dealing with an extremely large discounted relative PE for small cap issues. Right now, they're trading at a 37% discount to the relative PE average over the last 20 plus years. So our feeling is that there's an awful lot of upside potential. We have been seeing a broadening of participation in the sub-industries within the S&P 1500, and I think that is encouraging.
Hey, Sam, you've written really nicely in the last couple of months about so-called bogus bottoms in bear markets and the degree to which the S&P's recovered the lows at a certain percentage. Rarely or ever does it not result in further gains. Has that debate sort of been resolved at these higher levels?
Not necessarily. So thank you for reading my reports, Carl. What we found is that through July of this year, 87% of the bear market that we experienced in 2022 had been recovered. And every other bull market since 1949 recovered 100%. And if your definition of a bull market was that we're not in a bull market until we recovered everything from the prior bear, we would not have seen a bull market in the entire 1930s, 1940s, and half of the 1950s. So we look at a 20% advance that has retained this above level reading for at least 12 months, and that's exactly where we are now. But because of the fact that the Fed has been on a tightening policy during this bull market run, which it had not in other bulls except for 1988, that I think has put a lid on the exuberance that investors could exhibit.
What about the presidential cycle? I know you've been looking a lot at that as we go into an election year and what that might mean for certain parts of the market. What have you found? Absolutely.
Well, very, very encouraging. Since 1945, when you look at the pre-election fourth quarter for first-term presidents, which is where we are today, the S&P posted an average total return of close to 6% and never declined. That was the most important part of that issue. For the full election year, S&P gain was close to 15.5%, also never declining. So first-year administrations, whether the president gets reelected or not, tend to be positive for stocks. That has been echoed by the S&P Mid-Cap 400 since 1995, and an 86% frequency of advance for the Russell 2000 since 1980, with the only slip-up occurring in 1984. So certainly not a guarantee, but an encouraging statistic.